Hello and welcome to our December 2025 market update. I am Doug Johnson, Senior Investment Strategist here at HCM Wealth Advisors, and I am joined, as always, by my colleague Dan Rink. He's also an investment strategist here at the firm and a member of our investment committee. Dan, how's it going?
Pretty good, pretty good. How about you?
Doing all right. Some interesting times in the market here. We thought we were gonna get a big sell off, or at least not us personally, but I feel like a lot of people in the media thought that a few weeks ago this was it. And sure enough, we're right back where we started, close to all time highs, and looking to do some good things into year end.
Absolutely.
All right, well, let's go ahead and dive into it here. And why don't you kind of give us an overview of where we are after that? We'll call it a 5% sell off.
Yeah, we are back to where we were before it. I feel like, over the last 3 years, we've constantly said this is the most hated bull market of all time. Um,
I think it still is.
it still is for sure. You've seen every headline is investors being extremely pessimistic, sentiment being bad. Through this drop, this 5% drop last week, you had sentiment numbers that are showing you numbers that we see during washout periods. This chart here shows a company called 314, their daily composite of sentiment, and we dropped below 40. And the 40 level on their indicator basically only happens about 20% of the time. So it's a rare occurrence and it's happening at all-time highs. And then below 40, the you know expected annual return is essentially astronomical. I mean, you're looking at 39% returns over the next year based on these really low sentiment levels. So it's kind of odd that we're seeing such poor sentiment during a seemingly very healthy bull market. Um, Another thing to go on with the sentiment is we're seeing a lot of thrust indicators. So thrust indicators typically happen um, when there's washout sales. So this right here is a chart of an almost Zweig thrust. So a Zweig breadth thrust goes from um, 40% of all issuers advancing to 61.5% of issuers advancing in 10 days. So essentially, that's saying we went from really, really, really significant selling to really, really significant buying in less than 10 days. If you think of periods in the market where that happens, and it's typically at capitulation levels and market bottoms. You get a huge washout after, the market drops 20%, and then that ends up being kind of the bottom. It exhausts all the sellers, and then the buyers come in and basically start a new rally, and we just got one. Well, almost. So the number we needed was 61 and a half. My calculations on it show we were about 60. Um, and again, if we go from really, really bad advancers under 40 to, here 59 and a half, which basically shows there was large selling and then significant buying that followed it. The forward returns are very strong.
I think something
So
else
if you
that's
look,
crazy about this, if you look at this chart, like visually, you can barely even see this sell off period that we just had.
yeah, absolutely.
Um,
Like this does not happen in 5% drawdowns. It's showing that there is some really extreme pressure that is alleviated very quickly because the buyers come in and reverse it almost immediately. Um, and it's not the only thing we're seeing. So this is the McClellan oscillator, another kind of advancer decliner ratio, and it's showing pretty much the same thing. We had really significant selling on this 5% pullback, which is wild to say. Um, So people were basically throwing the baby out with the bathwater on a 5% pullback and then turning around and buying it all back because I guess they got the all clear. I don't know. But again, the 6 month, 9 month, 1 year forward returns are, you know, very high. I mean, we're seeing 17.35% average return over the next year after seeing these in significantly strong reversals. So we have some really interesting trading activity going on, and honestly, it's surprisingly bullish. You wouldn't think at all-time highs we would be getting these really bullish signals, but here we are. Yeah, and this is again the NYSE, so this is kind of the whole market advanced decline issues. If this line is going up and to the right, that means the market as a whole is pretty strong and continuing to rally. Um, we saw a little bit of a blip on the radar in the far right. I mean, we've kind of been going sideways for a little bit. Um, if there's going to be significant deterioration, you're going to see that line starting to move down pretty significantly. The moving averages are going to start crossing over, but we're really just not there yet. It's
Well, we're
it's
almost back to all-time highs in this too, it looks
Yeah, we're almost back to all-time highs, which is uh, honestly more significant than you would think. Um, this is a very strong metric for market breadth. I mean, I know a lot of the coverage and news is always about these top names, these AI names, but under the surface, there's a lot of equities that are participating in this rally. Maybe not to the extent of some of these really high octane names, but this is a pretty strong market. And then, we're in Santa Claus season. So, a lot of people talked about that 5% pullback saying like, oh, Santa Claus rally is canceled. Well, typically the returns in December start around the 15th of the month and continue through the end of the year. So, if we're still kind of on schedule for a Santa Claus rally because we're back to essentially all-time highs. 1.4% doesn't seem like much, but it really gives you a good base going into the next year. And, you know, this period of sideways motion is not uncommon. And again, this goes into the full November 25th to Christmas period. Uh, it's a pretty strong period, only kind of behind the October November period and the March to April period. On average, the market has gained 1.3%, and this goes back all the way to 1945. So, this is a good time of the year to be owners of equities, and I don't see anything that I've been looking at that would say that the Santa Claus rally is canceled at this point.
Yeah, and what's interesting is they bracket this from November, December, and then you go to the other side, it's December, January. So I think if you probably even put these two bars together, it would look like this time period is even stronger than they make it appear to be on this.
Yeah, it's
Now,
it's a it's a very very strong period of the year.
yeah. Now, as
So
always, caveat it with it doesn't have to happen that way every year, but
yeah, it's just an average. And then one kind of area of the market that I really like to look at as kind of a gauge of the overall economy is the Dow transports. Now, this isn't an index or an ETF that you would typically own. It's just one that you can kind of look at to see how the overall economy is. So the transports are, everything that is moving goods to the end user, moving actual physical product. Um, and I'm looking at this chart, and to me, this looks like the economy looks like it's in a really good spot. Um, we're back to all-time highs. We've put in a very strong base, and we are looking at a period where if we break out here, there's a lot of room to run. Now, what that means is the economy under the surface, which we'll touch on some concerns about it later. The market is saying that the economy is in a pretty good spot. These companies are doing well. They're, moving goods, trains, UPS, like all of the companies that are moving all these goods to the end user are in a strong spot. The old adage is if you want to know where the Dow's going, look at the transports. Well, the transports look pretty good right now. That is a pretty strong pattern, and we could be looking at a breakout that would really help the market. Um, Now the other side of the coin here. So this chart here is the rolling 36-month price return. So basically, how well the market has done over the last 3 years. If the line is going up, that means the market has done really, really well. If the line is going down, that means, we've had some underperformance. Um, Through this period, we are currently at about 1.5 standard deviations above normal. So that means we've, performed really well compared to the average S&P over the last 3 years. Um, which is great. We've participated in that market. We've collected some good returns over that period. From a statistical standpoint, if that average gets too high, if we get to th two standard deviations, the average return over the next year is -3%. So that's basically saying we've had some really good returns over the last 3 years. Returns looking forward might be a little bit lower just to bring us back, down to reality a little bit. Now, this isn't saying the market's going to crash or anything like that, but it would not be out of the question to say after this period of really strong performance where, equities take a little bit of a breather. Again, this is an average. That doesn't mean it's going to happen. But through periods of really strong returns, it's not uncommon for us to see, more muted equity returns after those really strong periods. And then, back to sentiment. It's, we've said it before earlier in this, it's a very hated bull market. This is actually the institutional asset allocation survey. A lot of bears in there. Like it's very interesting. Doug, why do you think this bull market has been maligned so much and just cast aside as not
Well,
being something we want to participate in?
I think, and again, I don't want to go off on a tangent here, but I think this market has just evolved in a way that is different from what a lot of us have, been classically trained to pay attention to. So, valuations are one of those things where, 15, 20 years ago, it was kind of like that was the first thing that you looked at and
Mhm.
try to kind of determine where you're going to allocate money from that point. And it seems like those type of things, I mean, they will matter again, but it seems like they've just mattered less and less as we've kind of looked at that. I think there's the AI story is, I mean, it's kind of like politics. It's very polarizing. You either have people who think it's going to change the world for the better, and then you got people who think it's going to be a replay of, the tech bubble in 2000. So, yeah, I mean, most bull markets I think get hated as they get further along in the cycle. But I mean, even outside of sentiment, like I think the other challenge is like inside of this market, it's like diversification. There's definitely a bear market in diversification. I think we might have said that at the last, in the last one, but I think it's true. I mean, look at this. You have 158 stocks outperforming the S&P 500 index. And that's the third narrowest year going back to 1960. So the only ones that have been worse were 2023, which was 2 years ago, and 1998. So, you know,
And 2024 is right there as well.
yeah, I mean, it's hard to see, but yeah, 2024 is this bar right here. So I think the challenge is like people have been also uncomfortable with the idea that okay, I just have to own these, we'll call them seven stocks to be doing really well. And I think the returns over the past few years have been such where diversification people have started to sour on it a little bit. Maybe there's a little bit of greed coming in. But yeah, I mean, and then you look at this, another way, you got more than half the S&P constituents trailing the index by 10% or more. So, looking under the surface, there's still a lot of stocks that have not necessarily done well this year. They're mid single digits. I mean, the S&P's up close to 17% this year. So even underperforming that index by 10%, you're still positive. But there's a
Hmm.
lot of, there's a lot of names that have been negative this year that you would expect has done well. So I think, we would like to see a broadening out of this rally for a sustainable period of time, because I think we've seen it in bits and pieces. It just hasn't, been able to maintain any kind of sustainability, but it hasn't seemed like it's mattered. Um, but I think as we look back at 2025 and kind of look at a series of, we'll call it shifting narratives. You started the year with this kind of international outperformance and push. Now I know there's a lot of lines in this chart. Let's focus on two colors. Let's focus on yellow, which is the S&P, and then let's focus on, we'll call it navyish blue, which is Europe. Um, so we see, a divergence between these two going into the beginning. Then you've got this tariff issue, which, everything, sell America. And you've got, probably the widest dispersion of foreign versus US returns that we've seen in a long time. Everybody kind of caught on, paid attention to it. And now you go all the way here to the end, and look, we're right back to where we started. The US seemingly has, once again become the powerhouse here through the second half of the year. And there's still some international markets that have done well, but it seems like the same old story where the U.S. just has that earnings power, that pricing power, and the markets there, or here, I guess I should say, continue to perform well. Now, as we kind of shift to the economy, economic growth is still projected to be pretty strong. I mean, outside of, or we continue to hear about, calls for market crashes, but, we also continue to hear calls for recessions. Recession's right around the corner. 2023, I think the expectation for recession was, it's almost guaranteed to happen. And here we are without, we haven't had one. And you've got the Atlanta Fed now projecting close to 4% GDP growth in the third quarter. That's a big, big number.
I haven't seen that number in a long time.
No, that's a huge number. And then you've got, even the top and the bottom ranges of most forecasts, the top 3.5, the bottom, 1.5, that's just not recession. At least not yet. I mean, the data just doesn't seem to be backing that up quite yet. Another huge component to all this is earnings. Historically, what happens with earnings season is you get high estimates that get revised down. Right. So 2023, these really high estimates, then they get revised down. 24, kind of the same thing. 25, not so much. But 26, you had it start, but then all of a sudden you've got this kind of reacceleration of earning expectations. And if you just want to do it on a cumulative basis, this red line here, continuing to trend higher. And, it's hard to have a market crash or even a significant sell-off when you have earnings growing at the rate that they are. And you even have that projected in the next year. I think that the 2026 earnings projections are, between 10 and 13%. So, there's a lot of fundamental backing that's taking place right now to what I would say, at worst, support the market where it is, and at best, continue to see this rally advance. Another thing that we haven't talked about in a long time is rates. You have almost no central banks in either the developed or emerging world that are raising rates. And we can see, you go back to, we'll call it 2022, beginning of 23. This line represents the percent of central banks that have cut rates or kept them the same in the last 6 months, right? So here, when everyone was raising rates, it's almost non-existent. Now you're almost back up to that 100% level where central banks are easing. They are not tightening policy anymore. So you have cutting across the board. There's expectations that the Fed is going to continue to cut. Quantitative tightening has stopped, and you're even starting to hear some rumors about the possibility of quantitative easing starting again. So this is the type of backdrop that historically has been positive for markets. Now, let's look at some of the things that may throw a wrench in all of this. So we've got the presidential cycle. That just shows really the 4 years between presidential elections and kind of how those play out. So the top box here shows the S&P 500 index from a performance standpoint. Now, historically, the first 2 years of a new president has been somewhat mixed. You get a good first year, you get a less than good second year up to a point, and then years 3 and 4 are usually pretty good. Now, what's interesting is historically year 2, which would be next year, struggles a little bit because you have this monetary and fiscal policy index declining for whatever reason. If you look at what we are projecting for 2026 in terms of fiscal and monetary policy, it is the absolute inverse of this, right? So what we just talked about, you've got rate cuts. You've got the possibility of quantitative easing, or at least conditions loosening from a monetary standpoint. And then you have the fiscal situation expanding either through the one big beautiful bill. It's just like this situation, I don't think is going to play out from a monetary and fiscal standpoint next year. So as we say, these are just cycle analogs. They don't, there's nothing set in stone here. But I think, if there's concern about kind of a sell-off next year based on the cycle, I think this is not going to be headed down like it normally is. I think it's actually going to go the other way. So that could end up being a positive. Now, when we talk about leading indicators versus coincident indicators, all right? So historically, or at least in this chart going back to 2000, if we ran this back further, it would continue to show the same thing. But when this light blue line, which is the leading economic indicators, crosses below this coincident, which is kind of the here and now, normally it is followed by recession. So we can see very clearly, break here, recession comes, break here, recession comes, break here, recession comes. You've got a big, big divergence here with seemingly no effect on the economy. So, this has been a pretty good indicator of economic weakness going forward. I'm not quite sure why we're seeing such a big divergence here, but this is certainly something to pay attention to, as we don't want to just be blinded to everything being perfect. The name of the slide is not all roses, because, this is one thing. I think if you were making a pros and cons list of reasons you should be aggressive next year, this would definitely fall, I would say, on the con side. Because historically the market actually front runs recessions as well. So you would see a market reaction before you actually saw an economic reaction. So as we look at 2026, from a thematic standpoint, I think there's two big themes that are going to continue, but I wanted to touch on them specifically because, we've done a lot of work behind the scenes trying to figure out ways to best express these themes from an investment standpoint in our portfolio. So one, I would call the AI build out. Obviously, AI has been a huge topic for the last year and a half, but putting some numbers behind what the total build out is going to look like going forward. So this was a study done by a company called the Business Research Company. and their AI system spending projection on a global basis from 2024 at 174 billion going up to what would essentially be, I think, $1.2 trillion in 2029. So that is a 47.6% annual increase uh, in the amount of spending going on in the AI space. That is an absolute staggering number to see. Now, when we look at what is kind of the major trends here, I highlighted this because this was a comment from this report. So major trends in the forecast period include AI and edge computing, cybersecurity, quantum computing, AI integration, AI-driven personalization, and strategic collaboration. So if you've noticed, we've added some specific kind of ETFs that cover some of these areas, both in the cybersecurity and what I would call the larger AI ecosystem, to try to capture some of the spend out that is projected going forward. Another one is kind of the energy space. You see this chart here. It says we're facing an impending power crisis. That may be a little bit dramatic, but all these data centers and AI build out is going to take energy to try and power this stuff. And the peak supply by 2032 definitely does not keep up with the demand that's going to be needed to power all this. So we've also looked at some ways to get exposure to what we expect to be a pretty high energy demand to power this AI build out. And finally, let's look at some perspective slides here as we wrap up 2025. Because again, I think this was a year of a lot of different narratives going back and forth. You had the beginning of the year into the tariff situation that was going to crash the market. It was going to accelerate inflation back, and then that came and went. And then we've had a pretty strong rally since then, and now we've got this kind of AI tug of war where, like I said, there's very extreme opinions on this. It's either, hey, this is going to turn everybody into billionaires, or this is going to crash like 2000. And the truth is always somewhere in the middle. I'd like to believe it's closer to the former than the latter, but so when we look at the number of greater than 1% daily declines in the market by calendar quarter, 2025 has been fairly benign in the back half of the year. So first quarter, which again had a lot of that tariff selling, you had 13 days. Quarter two, you had 8. In the third quarter, you had 1 day of greater than 1% decline. And then so far, we've had 4. So, I mean, compare that to 2022, where some of these, you've got double digits every quarter, or some of the years where we had very low volatility. So back half of 2016 and 2017. So, just a reminder that, volatility within a relatively good year is not uncommon. We certainly saw that the first half of the year, but from a volatility standpoint, things have been pretty quiet this year. And then back to this idea that the market has to go down because it's gone up so much. Right? I see a lot of comparison between this and 2000, and I've kind of said I think I want to say it's a little bit of lazy analysis, because it's like, oh, this is driven by tech, that was driven by tech, so the two have to be the same. I guess in some instances they could be, but from a price perspective, if you look at the NASDAQ 100, the rolling 5-year percentage change, all right? So going back, we'll just take this back to COVID, all right? So the numbers have been high, but they're not astronomical. You go back to the tech boom, the returns in that period were insanely high. All right, the NASDAQ went up 10 times during that period, and then it lost all of it. Right? We have not seen price returns that are even approaching that level yet. So if your argument is that this has to fall apart because prices have gone up too much, you need a different argument because it just doesn't hold water. Um, it's different in terms of so many things that, if you want to make the case from valuations and other things, all right, we can listen to that, but price just it can't be one. I mean, this price increase was something we may never see again across the board. So, I thought that was just an interesting way to look at it. And then finally, let's get to market crashes because for whatever reason, this seems to be a hot topic. We get questions about it all the time. This slide's kind of a Rorschach test, meaning a bear is going to look at it one way, a bull is going to look at it another way. So let me tell you what I'm taking away from this. So this shows the years between crashes in the market. What is defined as a crash? Greater than 40% bear market in the S&P 500. So big number. All right. What I see here is some very long sustained periods without having market crash. All right. So from 1938 to 71, you had 36 years without that taking place. That's a very long time. Right after that, you had a 27-year period where you did not have big crash. Okay. Then we had we had 2000, then we had 2008. So 7.5 years between two 40% crashes. That's a pretty short amount of time between that. So right now we're sitting at 18% or 18%, 18 years. All right. So what you see is that a majority of the time for the market going back to, we'll call it, I think 1929 is on here. The market's expanding. And it can go very long periods without having to go through these massive sell-offs. They're going to happen again at some point. But just like the last slide, if we're looking at this and saying it's just been a long time since it's happened, so it has to happen, history would tell you that that's not the case, right? There will be another large market sell-off in the future. We don't know when it's going to happen. We are not going to try to guess that it's going to happen and allocate portfolios accordingly to it because we could be waiting for another 10 years for it to happen. And in the meantime, there could be a lot of good things that happen. So I just want to re-emphasize that, we have policies, procedures in place that are extremely data driven that give us indications when risk off events are more likely than not. And right now, we just are not seeing anything in the data that would suggest that there's going to be a significant sell-off, let alone a market crash. So as we go into 2026, just keep that in mind. Our expectation is that there's enough fundamental backing right now that is supportive of markets, and we would expect that if things continue like this, there's no reason that we can't see a follow through this, and have another good year where you've got high single digits, possibly low double digit returns for equities. We want to maintain some diversification, understanding that in markets like this, that could cost some return, but we still feel like that is the best way to be invested for long-term investors because there's a lot of noise over the short term, but markets become a little bit more predictable is probably not the right word to use, but I'll use it anyway. A little bit more predictable in terms of what the range of returns is going to look like going forward. So I think that's kind of a wrap here for what we've got on a 2025 basis here. Our goal would be to start fresh again in 2026 with these updates. Obviously, if something significant happens, we will break that schedule. But for now, our goal is to have this next update come in the beginning of 2026. As always, we appreciate your business. And if news breaks before then, we'll obviously we'll have another update. But other than that, have a great holiday, and we'll see everybody next year.